There is always a loud story in the market, a trade war, a tariff shock, a breaking headline that arrives with the confidence of a fire alarm. And then there is the quiet story. The quiet story is where real money usually gets made. Not in the panic, not in the hot take, not in the daily refresh of a chart that looks like a heart monitor, but in what I'd call the long, boring corridor. That stretch of time where disciplined businesses do the same smart thing over and over and over again, until the world wakes up one day and realizes they built something almost impossible to disrupt. That is the corridor most people cannot tolerate. It is too slow for social media, too unglamorous for television, too practical for people addicted to drama. But when tariffs rise, when global supply chains wobble, when entire sectors start sounding like emergency broadcasts, the companies that come out strongest are often the ones that spent decades making themselves boring on purpose. They built invisible supply chains. They built local redundancy. They built domestic production. They built ownership over the critical parts of the machine. So when the noise gets expensive, they do not have to become geniuses overnight. They just keep walking down the corridor. And today, that is the story. Not the loud companies, the quiet ones, not the businesses begging for a policy miracle, the ones that prepared so thoroughly that a tariff headline feels like weather. Not pleasant, maybe, but not life-changing. These are the Camrys of corporate America. Reliable, paid off, unassuming, and a lot more powerful than they look. Because there are really two kinds of companies in a tariff-heavy world. There are the Camry companies, and there are the lifted truck companies. The lifted truck companies looked amazing when money was cheap and labor was cheaper. They financed growth with distance. They outsourced resilience. They trained themselves to believe that the lowest short-term cost was the same thing as strength. And now the bill is arriving. Tariffs go up, freight shifts, political risk returns, and suddenly the monthly payment on that entire model gets very real. Every quarter becomes an apology tour. Margins got squeezed. Guidance got revised. The consumer got cautious. The supply chain got complicated. The environment got uncertain. But the Camry companies do not sound like that, because they were not trying to look rich. They were trying to stay hard to kill. Take Nucor. Nucor is not a story stock. It is not trying to seduce you with a futuristic promise. It is a deeply physical business that spent years building control over the ugly, essential parts of steelmaking. It recycles massive amounts of scrap. It runs electric arc furnaces. It owns scrap processing capacity. It operates direct reduced iron plants. It has spent years making sure a meaningful portion of its raw material supply is under its own control. That matters because if your inputs come from your own network, if your facilities and customers are mostly in North America, and if your logistics are built around material you already understand, then a trade shock is not the beginning of your identity crisis. It is just a meeting. Then look at Steel Dynamics. Again, not flashy, not loud, not pretending to be something magical. The company describes itself as predominantly domestic. It runs a circular manufacturing model built around recycled scrap. Its recycling platform feeds its own operations. Its downstream businesses buy steel from its own mills. That is not just production. That is self-defense. That is a company saying, long before the panic starts, we would like to own more of the answer. And that is what the market often misses. Resilience rarely looks exciting while it is being built. It looks redundant. It looks conservative. It looks like management is leaving some glamour on the table until the environment changes. And then all that boring preparation starts looking like genius. Now widen the lens. This is not only about steel. The same logic shows up in businesses where geography itself creates a moat. Consider Vulcan Materials. Vulcan sells aggregates, crushed stone, sand, gravel, the kind of materials nobody brags about at a dinner party. But aggregates have a beautiful economic characteristic. They are heavy, they are cheap per unit, and they are expensive to move long distances. That means the business is naturally local. You cannot casually replace nearby reserves with some clever imported substitute and expect the math to work. Transportation starts eating the advantage. Permitting becomes a barrier. Location becomes strategy. Vulcan's moat is not hype. It is rock in the ground, close to demand, protected by time, zoning, and infrastructure. That is what a boring corridor business looks like. It does not need to win the argument online. It just needs to exist in the right place for a very long time. And that brings us to one of my favorite ideas in business: the density of no problem. Real wealth, whether for a person or for a company, is often just the absence of recurring emergencies, not endless abundance, not visible luxury, just fewer things that can break you. A great business is often a machine that converts inputs into calm, raw materials into calm, distribution into calm, capex into calm, operational discipline into calm. That is what companies do when they anticipate trade shifts years before the headlines. They build a fireproof box, not literally, but structurally. Multiple suppliers, regional manufacturing, owned logistics, internal processing capacity, local distribution, long-lived assets. So when policy changes, when tariffs spike, when imported components get pricier, the board does not treat it like an extinction event. It is a rounding error conversation. A problem, yes, but not a panic. And you can see that same architecture in Sherwin-Williams. Sherwin-Williams is easy to underestimate because people know the storefront before they understand the system. But behind the paint stores is a supply chain business: procurement, manufacturing, distribution, thousands of retail points, a broad North American footprint. This is not a company hoping the world stays frictionless forever. This is a company that built a real operating network. And when you own more of the chain, when your regional footprint is deep, and when your product is tied to a local service model, you are less exposed to every tremor in international trade. Not immune. Very few companies are fully immune, but far less fragile. And fragility is expensive. That is the hidden cost the loud companies rarely mention. They will talk about efficiency. They will celebrate asset-light models. They will praise flexibility. But sometimes flexibility is just a polite word for dependence. And dependence is cheap right up until it isn't. That is why some of the quiet winners are hiding in plain sight, inside so-called ordinary businesses. Take Somnigroup, the company formerly known as Tempur Sealy. On the surface, mattresses do not sound like the battlefield where supply chain intelligence reveals itself. But look closer: owned manufacturing, distribution centers, logistics capability, retail presence, R&D, a vertically integrated structure designed to move product through its own system. That is the pattern. The quiet winners are often not selling spectacle. They are selling control. And control is incredibly luxurious. Which brings us to the idea of quiet luxury. Not the kind sold through logos. The real kind. The luxury of never having to think about a problem again. That is what vertical integration can become when it is done well. Not a vanity project. Not empire building. Not corporate swagger. Just peace. If you own your critical production steps, if your facilities are where demand lives, if your supply chain was designed for friction instead of fantasy, then your advantage does not need a commercial. You become indifferent to the scoreboard, not because trade disputes do not matter, but because they matter less to you than to the company that rented its entire business model from a fragile global moment. The loud market often rewards reaction. But guidance, change suppliers, reshuffle production, announce a task force, signal urgency. But some companies quietly win by not reacting. That sounds passive, but it isn't. It is the reward for having already done the hard thing. The best management teams are not day trading their supply chains. They are not rebuilding the house every time the forecast changes. They are elite at not interrupting a strategy that was built for turbulence in the first place. When the entire internet is certain the system is finished, they are still allocating capital to the same plants, the same routes, the same customer relationships, the same domestic footprint. And that discipline matters because companies can waste enormous value responding theatrically to every burst of market anxiety. The noise becomes a management style. Every quarter becomes improvisation. Every headline becomes strategy. Every shock becomes an excuse to abandon long-term thinking. But the quiet compounders understand something deeper. If the machine is good, interruption is costly, so they keep the machine running. That is why the strongest businesses in a tariff-heavy era may not be the ones making the boldest statements. They may be the ones saying almost nothing, the ones whose infrastructure is already paid for, the ones whose supplier web is already diversified, the ones whose domestic base already acts like home equity, the ones who spent years turning dependence into ownership. And that is what makes them look so boring. They are fully paid up. No need to posture, no need to perform, no need to rehearse an identity every earnings season. Just plants, reserves, routes, contracts, processing capacity, and customer relationships, all sitting there like a quiet moat. If you want drama, you will not find it there. You will find something much more useful: reliability. And in markets, reliability is often underpriced because it is not entertaining. But zoom out 10 years. That is where the picture gets interesting. A decade from now, some companies will still be explaining why the old model almost worked, why overseas dependence was rational at the time, why the margin pressure was temporary, why the latest restructuring is different, why shareholders should stay patient just a little longer. They will still be managing consequences, still drowning in expensive noise, still translating fragility into polished conference call language, still rehearsing apologies. And then there will be the other group, the quiet winners, the businesses that spent the hard years building systems instead of stories, the ones that understood real wealth is silent, the ones that made tariffs inconvenient, not fatal, the ones that treated domestic capacity like an asset, not a slogan, the ones that built vertical integration not for bragging rights, but for the luxury of fewer surprises, the ones that kept walking through the long, boring corridor while everyone else chased excitement. And on some random Tuesday afternoon, 10 years from now, they will still be doing what they do best: nothing beautifully, just operating, just delivering, just compounding, just making the whole thing look almost too uneventful to matter, until you compare outcomes. So here is the real question. When you invest, when you evaluate businesses, when you decide what kind of resilience actually deserves your capital, are you buying the expensive noise? Or are you buying the invisible wealth? Are you chasing the headline or the corridor? Are you betting on the company that needs the world to stay easy, or the company that prepared for the world to get hard? Because the market will always give you something loud to look at, but the quiet money is usually being built somewhere else, probably behind a fence, inside a plant, along a rail line, near a quarry, inside a distribution network, inside a business so unassuming that most people stop paying attention. And that may be the whole advantage. The best companies do not always look rich. Sometimes they just look paid off.